If someone gave you $10,000 today and told you to invest in gold, what would you buy? A gold coin, a gold ETF, shares in mining company, gold jewelry, or perhaps even Bitcoin, often called digital gold. Surprisingly, there isn't just one way to invest in gold. There are several, and each one comes with its own advantages and disadvantages, risks and opportunities. Some investors want maximum convenience, others are looking for growth. Some want to speculate, while others simply want to preserve part of their wealth outside the traditional financial system. Today, we'll compare 7 of the most common ways to invest in gold. We'll look at the strengths, the weaknesses, and the type of investor each one is best suited for. By the end of this video, you'll have a much clearer idea which approach may fit your own goals. For thousands of years, gold has been one of humanity's most trusted stores of value. Owning physical gold means exactly that. You own the metal itself. No company, no financial institution, no intermediary. For many investors, that's its greatest advantage. Physical gold also carries no counterparty risk. Its value doesn't depend on a company's management or someone else's promise to pay. However, physical ownership also comes with responsibility. You must think about storage, security, insurance if necessary, and you'll usually pay a premium above the spot price. Physical bullion is often best suited for investors whose primary goal is long-term wealth preservation, for people who value direct ownership, and for those who prefer to keep at least part of their wealth outside the traditional financial system, independent of banks, brokers, and to a certain extent, governments. Not everyone wants to store gold at home. Gold exchange traded funds, or ETFs, allow investors to gain exposure to the price of gold without owning the metal directly. Buying and selling them is simple. They are highly liquid and they require no storage. However, you generally don't hold the gold yourself. Instead, you own shares in a financial product designed to track the price of gold. Most ETFs also charge annual management fees. Many investors also use gold mutual funds. They serve a similar purpose, although ETFs are generally more flexible and easier to trade. Gold ETFs are often suitable for investors who value convenience, liquidity, and easy access through a brokerage accounts. You can buy and sell them with the push of a button instead of driving to a dealer, sometimes hours away. This approach is different. Here, you are not investing in gold itself. You are investing in companies that explore for mine and produce gold. If gold prices rise, mining companies can sometimes rise even more, which makes them attractive to investors looking for growth. Some companies also pay dividends. On the other hand, mining companies remain stocks. They are affected by stock market volatility, management decisions, operating costs, political risks, and many other factors. It's entirely possible for gold prices to rise while a mining company performs poorly. Mining stocks and mining ETFs are generally better suited for investors seeking growth rather than simply preserving wealth. Futures and options are financial contracts, not physical ownership. They allow traders to speculate on future gold prices, often using leverage. These instruments can be useful for professional traders or for hedging certain risks, but they are also highly complex. A small market movement can produce large gains or equally large losses. In some cases, an investor can lose the entire amount invested, especially when using excessive leverage. For most long term investors, these products are simply more risk than they need. Gold jewelry is perhaps the oldest form of gold ownership. Unlike a gold bar, jewelry can also be worn. In many cultures, it represents beauty, tradition, family, and wearable wealth. It can also be passed from one generation to the next. However, jewelry usually carries much higher premiums than investment bullion. Part of what you are paying for is craftsmanship, brand, design, and sometimes gemstones. If your primary goal is investing rather than fashion, simple pieces with high gold purity and few or no stones often make more financial sense. Otherwise, you may be paying for gemstones that add little or sometimes no value at all when it's time to sell. One interesting aspect of gold jewelry is that, historically, it has often been treated differently from investment bullion. For example, during the US gold restrictions of the 1930s, certain gold jewelry was generally exempt from the rules that applied to many gold coins and bars. History doesn't guarantee the future, but it shows that jewelry can sometimes occupy a unique position compared with investment bullion. Once, I was visiting a country and I found another interesting option. If you personally knew a trusted jeweler, you can sometimes buy used gold jewelry priced mainly for its gold content. They call it gold to break because it will be sent to the refinery. It was even cheaper than buying newly minted coins or bars. Unfortunately, opportunities like that don't exist everywhere, and they depend entirely on finding someone you truly trust. Over the past several years, some people have described Bitcoin as digital gold. The comparison comes mainly from its limited supply and the fact that it isn't controlled by a central bank. However, Bitcoin and physical gold are fundamentally different assets. Gold has served as money and a store of value for thousands of years. Bitcoin is a much newer technology. Many believed Bitcoin might eventually replace gold as the preferred hedge against financial uncertainty. So far, that hasn't happened. Instead, Bitcoin has largely remained a highly volatile and speculative asset. That doesn't necessarily make it a bad investment. It simply means it served a different purpose than physical gold for many investors. So, which one is the right choice for you? There is no universal answer. If your priority is preserving wealth, if you value direct ownership, or if you want to keep part of your savings outside the financial system, physical bullion may be the better choice. If convenience matters most, gold ETFs offer a simple solution. If you are looking for growth, mining companies may deserve consideration. If you are an experienced trader, futures and options provide sophisticated tools. If you want something you can wear, jewelry combines investment with personal enjoyment. And if you believe in digital scarcity, Bitcoin may appeal to you. Every investor is different, and every strategy reflects different goals. After considering all these different approaches, my own strategy is fairly simple. I consider physical gold and silver to be the foundation of my portfolio. For me, they serve two important purposes: long term wealth preservation and financial protection. I value direct ownership, independence, and the peace of mind that comes from holding a tangible asset. At the same time, I also invest in gold mining ETFs, not because I see them as a replacement for a physical bullion, but because they serve a different purpose. They provide me with exposure to potential long term growth. I believe global demand for gold and silver will continue to increase over time, and mining companies may benefit from that trend. So while physical gold and silver form the foundation of my strategy, mining ETFs represent the growth oriented part of my precious metals portfolio. Your own conclusion may be different, and that's perfectly fine. The important thing is to understand what you are buying, why you are buying it, and whether it truly matches your own financial goals. This is Old World Bullion from Europe. See you next time.